Hey guys, welcome back to the channel. Today I'm going to be covering the fall of Three Arrows Capital and the fact that they have just filed for Chapter 15 bankruptcy. So if you're new to the channel and you want to show some support, please leave a like and subscribe. So first I want to talk about the background behind Three Arrows Capital and talk about why this is such massive news in the market right now. So Three Arrows Capital was co-founded by Suzu and Kyle Davies, who have a background in investment banking, and basically they profited a lot off of arbitrage opportunities. So they made a lot of money from NDF trades, which are basically these currency bets in a contract that don't actually involve delivery of the cash exchange. So there were arbitrage opportunities for them in these NDF trades. For example, they would go to bank one and get a quote for, say, an exchange rate of 100 to 101. Then they would go to bank two and get a quote for 102 to 103. So they would take tiny amounts on these trades, they would take tiny profits and just do it over and over and over with tons of capital. Now the drawback of this is it's capital intensive and it's not insanely profitable, but it is a good and lucrative opportunity. That's kind of their background. And the reason this is important because it helps us understand the process as they transitioned into the cryptocurrency ecosystem. So arbitrage is great and it's lucrative, but again, it is capital intensive, and you get slow, steady results as opposed to rapid growth, which is kind of what other funds were doing in the bull market. So what Three Arrows Capital did was they took on an arbitrage opportunity in crypto and levered up to the point where they took out huge loans with little to no collateral as backing. And they ran it through yield opportunities like Anchor Protocol. And for those unfamiliar, Anchor Protocol allowed people to deposit UST, the Terra USD stablecoin, for 20% APY. Now what they did was they levered up funds and they took pools to earn these 20% returns, and then they would pay back the loans with the profit being the 20% APY minus whatever interest they took to borrow the funds. So they were massively over leveraged, but they were severely under collateralized, which meant if they were liquidated, the lenders would not be able to get their money back. And basically because of how little collateral was posted, that had a pretty negative cause and effect on all the lenders, right? So fast forward to when they peaked out, they managed around $18 billion in assets. So this was one of the largest crypto funds. But when Terra USD got depegged and started that death spiral to zero, the liquidity tied up in these pools really hurt their balance sheet, and they got wrecked. They lost a ton of funds in this collapse. And then all the lenders who had kind of given them money without any real collateral as a backing, they started to ask for their money back. So Three Arrows Capital was trying to gather enough money and liquidity to pay back the lenders. So they were selling their cryptocurrency positions to try and manage funds to pay back these loans. But unfortunately, they could not repay everyone and ended up falling short. They put a ton of stress on the markets trying to liquidate everything and pay back loans, but they lost so much money in the Terra USD collapse, and they had their positions in cryptocurrencies reduce in value by 50% because the market was crashing. So eventually they did get liquidated, and if we go over to this article by Blockworks, we can see that BVI Court liquidated their assets on Monday. So eventually, following all these liquidations, they have started to protect their remaining assets in the United States with a file for the Chapter 15 bankruptcy. So as you can see, they're trying to basically preserve any sort of assets in the United States by filing for this bankruptcy. And I think, following this, there's going to be a lot of cause and effects, a lot of ripples throughout the market. We're already seeing that, but I think the damage is going to extend several more months. So obviously, I do think this is a pretty large event in the market, and this is just pretty shocking to come out with such massive effects on all these lenders and basically the contagion effects. But I do think it is good that the market is starting to hunt down these basically unsustainable funds and kind of filter out all of this unsustainability, because next time around the bull market, if they had not blown up, then it could have gotten much worse, right? They could have been a much bigger fund and blown up somewhere down the line later on at much higher valuations. So I do hope you guys enjoyed this summary, and if you have any comments or suggestions, please do leave those below. And as always, I will see you in the next one.